This is the Asia Trade. I'm Paul Allen in Sydney. The top stories this hour. Asian stocks set to extend losses from Wall Street as President Trump repeats calls for Jerome Powell to cut rates immediately, adding to worries about the Fed's independence. Trump's assurances that tariff talks are making progress, doing little to stop a sell-off in US assets that's challenging the biggest economy's long-standing financial dominance. And we discuss the trade war impact with a major Japanese exporter. Suntory CEO Takeshi Niinami joining us later on this hour live. All right, let's take a look at how futures are shaping up for this Tuesday morning in the Asia Pacific. Well, not surprisingly, it looks like we're going to see a little bit of red on the screen today. We did see a fair bit of selling in Japan yesterday, the Nikkei closing down 1.3%, perhaps a function of that much stronger yen. Right now, 140.73, which in itself, perhaps a function of a much weaker US dollar. We've got the offshore yuan, meanwhile, a little change there, 729.36. Chinese futures look skewed to the downside as well by about 0.25%. We're going to be reopening for trade here in Australia as well after a public holiday yesterday. A couple of stocks to watch here, Macquarie and Nomura in Japan. This is after Nomura agreed to buy Macquarie's US and European public asset management business for $1.8 billion in cash. So we might see those two big names moving at the open in just under an hour's time. Let's check in on how US futures are shaping up in the meantime. Wasn't a great day for US stocks. All of the major indexes off by about 2.5%. And futures also modestly to the downside at the moment. That Sell America trade continuing to gain momentum. This, of course, against a backdrop of President Trump repeating calls for Jay Powell to immediately cut rates, openly speculating about the processes required to remove him from his position. So markets really not liking that potential threat to Fed independence. Well, on that note, President Trump is stepping up pressure on Jay Powell, warning that the US economy may slow if the Fed doesn't reduce rates immediately. So for more on this, let's get to our senior national political correspondent, Nancy Cook. So, Nancy, let's just take a step back and ask ourselves, how realistic is it that the president could either remove Jay Powell or meddle in Fed independence, or simply the rhetoric enough?
I think that it's not just rhetoric at this point. I've talked with, several people who are Trump advisors, even some White House officials who say that Trump is incredibly frustrated with Chair Jay Powell. He has been really since the campaign, but I think he's just becoming more and more vocal about it as there's fears growing inside the White House about the state of the economy. I think that there is a real concern among Trump's advisors about what tariffs are doing to the economy and also the stock market, and they're looking for a place to shift the blame, and I think at this point it's falling on Jay Powell.
Yeah, well, President Trump says there's virtually no inflation and growth should be the focus for the Fed now. But we, of course, have a number of Fed speakers this week. What's the Fed's messaging on inflation at the moment?
Well, I think the Fed's messaging has just been to really stay the course and see what happens. And, Jay Powell is trying to, manage their dual mandate of full employment, but also tackling, inflation. And it's been a very tricky ride for him. I talked with several Trump allies and advisors last week who felt like the speech that he gave last Wednesday at the in Chicago, where he talked about tariffs as potentially adding to the inflation, that really irritated sort of the Trump and MAGA crowd. So I will be very curious to see what the president's reaction is this week. There are a number of top IMF officials and other economic officials descending on Washington this week. And I will be very curious to see how the president reacts to what I expect to be a lot of, messages about warning about tariffs, warning about inflation, and just sort of the global economic picture at this point.
Yeah, let's talk a bit more about those audiences in just a moment, but to just talk about Powell a little bit more. I mean, he's previously said that he's not going anywhere. Is it even possible for the president to remove him?
He has said that, and I would believe him, but I also feel like Trump has tested the boundaries of executive power on a number of issues since he has gotten back into power in the White House. We've seen him try to co-opt the IRS for political purposes with Harvard University. We have seen him go after universities for their diversity initiatives. We have seen him go after law firms. He is defying a Supreme Court order to, return a migrant who was deported to El Salvador mistakenly. And so he is just testing the boundaries of executive power on all manner of policy fronts. And so while Jay Powell may try to reassure the markets that he's not going anywhere, I would not put it past the president to still try to fire him and sort of see how the courts and what congressional Republicans do in that case.
Well, you also mentioned that the president's had a number of meetings, is going to be having more this week, but he has been holding an audience with the U.S.'s major retailers. What was the message that they were giving him there, and more importantly, was that message received?
Well, I think the White House, for several weeks now, has just been hearing from a number of top U.S. businesses and CEOs. That includes everyone from tech CEOs to retailers. And the message that they are trying to send to the White House are that these tariffs are bad and that the White House needs to back off of them. When we saw last Friday, actually, or 2 Fridays ago, excuse me, the White House created that exemption for smartphones and some electronics on the tariffs. I think that U.S. businesses saw a real opening there to try to get exemptions on a number of fronts. And so that's what's happening now. You're having a bunch of businesses call the president directly. You're having them call his chief of staff, Susie Wiles. People are calling anyone they know within the administration to try to get some sort of carve out or exemptions, or just to urge the administration to back off these tariffs entirely.
All right, Bloomberg senior national political correspondent Nancy Cook there. Thank you. Well, the annual spring meetings of the IMF and World Bank are getting underway in Washington, with the Trump trade war topping the agenda. Bloomberg senior editor Ramsey Al-Rikabi joins us for more from the U.S. Capitol. So, Ramsey, tell us what's the mood like on the ground there, and are these central bank leaders and finance ministers from around the world likely to have a receptive audience at the White House?
Good morning, guys. These meetings coming up this week typically always bring in these finance ministers, central bank governors, bondholders, bankers here into Washington. One of the main reasons why they come here is to sort of take a temperature of the global economy, the biggest risks. They do that at the IMF and the World Bank meetings. They also do it with the G20. Now, as you mentioned, as we've seen, the biggest risk right now to the global economy is coming from Trump and coming from Washington. So we have these tariffs and this trade war that have rattled markets, rattled economists. We're seeing downgrades on global growth, U.S. growth. We've seen Goldman Sachs, other banks downgrading their outlooks, even seeing a recession. We've had Bloomberg Economics today downgrade their U.S. outlook for this year by almost a full percentage point to 1.3%. So as these leaders come to gather and typically try to take a stock of what the challenge is, they're in a bit of a weird situation where they're going to have to look to the U.S. and say that these tariffs, these trade restrictions that have either going to knock demand in the U.S. or shock the rest of the planet need to be somehow revised. And there's going to be some sensitivity around how they do that, because Trump right now is looking for deals one-on-one with all of these countries. So there's a very fine line they need to be walking here.
Considering that Trump is looking to make bilateral deals with countries, how important are these sorts of gatherings for smaller countries that might be struggling to make bilateral deals? And also, what's the risk that a number of countries might just make deals among each other and bypass the U.S.?
Well, there's definitely a good opportunity for a lot of smaller countries, since they're in Washington, to reach out to not only the Treasury Department, which would be the typical host for something like this week, but also the Commerce Department and the USTR, to get a sense of what the U.S. is looking for, but also, I think more importantly, for the audience of Trump, like what they can offer. They're coming to talk about trying to buy more U.S. goods or lower tariffs or other non-tariff restrictions to essentially get on the good side. In terms of what countries could do, among themselves, that sort of remains to be seen. A lot of these forums were created by the U.S. or led by the U.S. to find like global policy approaches that could lessen the shocks or move on from other crises, if they're the global financial crisis or the COVID crisis. Now that this is being led by the U.S. and it's sort of a man-made crisis, It's going to be a tricky act to see how they can either work together or find a way forward with the U.S. Now, as I'm sure you've seen, Trump's approach is trying to bring on allies or bring on other trade partners against China. And China is the country that he sees as the biggest risk and the biggest beneficiary of the globalization that him and some of his trade advisors are trying to push back against. I don't know if it's going to be a situation where they can get all these countries on board, particularly some of the major partners against China. I think for a lot of countries as a market, China is still going to be an important ally or as an important outlet. But also, they're just as worried as the U.S. in terms of China's massive export-led growth now that it has a challenge with its property sector and a slowing economy. So everyone's got sort of facing these double shocks of both, the trade war from Trump on one side and the China export flood on the other. It's kind of it's a tough situation for all of them right now.
All right, Bloomberg's Ramsey Al-Rikabi there. Well, let's get a little bit more on markets now. Get to Markets Live strategist Mark Cranfield. So, Mark, it's been an interesting day, not just for U.S. equities, but also the dollar, the bond market as well. We're seeing strong evidence here that the U.S. is just simply not the haven that it once was. And to that end, we've got the Bloomberg question of the day that might be worth discussing at this point as well. It's like, how much further could the U.S. dollar fall this year? Is this an end to U.S. exceptionalism?
Yes, I think that we're seeing that taking place right in front of us. For macro traders, selling the US dollar and other US assets, but especially the currency, is really a key macro theme when you consider what's the fact that the global trade war probably has further to run, that tariffs are inflicting self-harm, as Ramsey was saying earlier there. It's really something which investors are not used to. They're not used to the United States causing pain to its own economy in such a way as that. And on top of all of those things were happening anyway, and the US dollar was under pressure, as was the long end of the Treasury curve. And then you throw on top of that, it's really like putting oil on top of the fire. When you put in question the chairman of the Federal Reserve's position, then you really are unsettling global investors way beyond those who were even considering the facts of tariffs and trade wars. So now you have a number of reasons why, if you're a global macro trader, you really want to position against the US dollar and look for alternatives. And clearly, some of the places we're seeing that is the euro, the yen, the Swiss franc. They're all starting to do extremely well. But it's going even beyond that. Yesterday, although it wasn't a 4 days trading, we didn't have European markets, and yet we saw Asian currencies performing extremely well. We saw the Australian dollar make a big rebound as well. So clearly it's something with traction, and it's really in the hands of the United States officials themselves whether or not they want to backtrack. If President Trump sounds more supportive of the Federal Reserve chairman, that will certainly help. If he does trade deals with various countries, that will certainly help as well. But for the time being, what people are looking for in a top-down point of view is that so many factors are telling them that US assets don't deserve the premium that they've had for many years. And at the center of that is the global reserve currency, which certainly central banks, they can reduce their holdings. It doesn't mean to say that the US currency won't be number one, but it won't be number one by the big margin which is held for so many years.
It's an interesting point that you make around backtracking, because it was only a few days ago, it feels like years ago now, that the president described markets getting yippy as part of the reason for the 90-day trade reprieve. Now, could we see something similar here? Because this is a president who's tied success very closely to the way equity markets perform. He expressed some concern about the way the bond market was behaving. Have we entered an era where markets have discovered they can bend the will of the president?
Well, this week has started off pretty much with the same kind of conditions that we saw, as you suggested, that President Trump did backtrack a bit, because US equities are starting very badly, around a 2% decline for the major indices there. Bond yields are steepened sharply, particularly with a lot of selling in the long bond end. This is something which has come to life. We've seen in the futures market as well, the biggest net selling for many years by global investors in the 30-year sector of the curve there. So that's something which the president was gaining confidence in the fact that he could get yields down not too long ago. Well, that's not happening. Bond investors are very much against him at the moment. The bond vigilantes are all over the Treasury market, and it's spreading to other parts of the world also. So the conditions that we are seeing this week develop already are pretty much the same as those that we saw when he started to give guidance that there will be a 90-day period of rest before tariffs came in, and he was reconsidering some things. So nothing much has changed from that point of view. Whether the message gets through to him this week or not, it looks as though the financial markets, the people that put big money to work, are giving him a very similar message to what they gave a couple of weeks ago. We do not like the situation right now, and we're moving our money to other places.
All right, Bloomberg's Mark Cranfield there. We do have more ahead on the Asia trade. Stay with us. This is Bloomberg. Tributes are pouring in for Pope Francis after his death at the age of 88. Italy's Prime Minister Giorgia Meloni called him a great shepherd, while President Trump says he and the First Lady will attend the Pope's funeral. In a moment, we'll discuss what's next for the Roman Catholic Church, but first, let's look at the life and the legacy of Pope Francis.
Pope Francis will be remembered as a spiritual leader who encouraged Catholics to embrace more compassionate views on many issues of church doctrine. But his legacy as pontiff will also be marked by his failure to deal decisively with past abuse by clergy. Born Jorge Mario Bergoglio in Buenos Aires, he entered the seminary in his 20s and joined the Jesuit order, known for its work on behalf of the poor and for social justice. Bergoglio later became a bishop of Argentina's largest archdiocese and eventually a cardinal before being elected the 266th pope in March of 2013. He captivated many liberal non-Catholics with his focus on poverty and human suffering at a time when far-right political groups were on the rise globally. But Francis's expansive message faced pushback from a polarized clergy and hidebound Vatican bureaucracy. He abolished the highest level of secrecy used to protect pedophiles within the church, yet largely failed to satisfy victims' demands for accountability. He advocated for a freer discussion of homosexuality, divorce, and the role of women in the church, but progressives didn't find him revolutionary enough, while conservative Catholics felt he went too far. He left a final institutional legacy reconfiguring the College of Cardinals that will select the next pope, making it more likely that person will be from Asia or Africa.
Well, Bloomberg Wall Street Week anchor David Weston joins us now with more. And David, certainly after the Pope exited hospital earlier this year, he didn't look well, but was there an air of determination about him to deliver that final Easter message?
Well, one would say so, wouldn't they, Paul? Exactly right. We saw him there, frail and limited in what he could do, but really insisting on presiding over Easter one last time. It's only fitting that he held on until the day after Easter, and Catholics around the world now are mourning his loss.
So we were just listening there to some of Pope Francis's legacy, and it's mixed, but it's difficult to satisfy, both conservatives and progressives within the church. How will he be remembered?
Yeah, any organization with 1.4 billion people, you're not going to make everybody happy all of the time, right? But I would say one of the things that's important to remember is what came before in Pope Benedict, who stepped down, who resigned, as you recall. And he was decidedly conservative, particularly theologically conservative, and was perceived to be so. Certainly, Pope Francis changed that direction, moved off of that. And as you heard in that obituary, he didn't please everybody, but he moved toward various constituents, including in the same-sex marriage area. He didn't bless them, but at the same time, he didn't condemn them. With women, he didn't allow them to be ordained as deacons, but he did move forward and gave them positions they otherwise would not have had. So there were a number of places, and even with respect to the sexual abuse cases, he was much more forthcoming in admitting the problems. Some people thought he went too slowly, that he should have gone faster, leader, but he clearly moved from what had come before and was seen, even if he didn't particularly like the term, I think it's seen as somewhat more progressive than what they had before. He reached out to a lot of younger people around the world and some of the fringe parts away from Europe. Particularly, which is fitting given the fact that he was the first non-European since, I think, the 8th century to serve as Pope.
Well, the Catholic Church is now going to bear witness to several weeks of impressive ceremony and some secrecy as well. What do we know about the funeral arrangements and the conclave for choosing Pope Francis's successor?
The date on the funeral has not been set yet. We have heard today from President Trump here in the United States and the First Lady that they will attend. Obviously, we'll have dignitaries from around the world. It will be a very big event. Obviously, covered on television. We'll all be watching it, no doubt. And nothing can go forward in terms of the choosing of the new Pope until that's all over. The so-called conclave usually happens between 2 and 3 weeks after the death of the Pope. And as you know, Paul, that's very secretive. I mean, it is the group of cardinals who are under 80 years old, that's about 135 of them, will get together in the Sistine Chapel, and they'll be locked in there, and it will all be very secretive until they can come up with a 2/3 majority, which is required to vote for the next pope.
All right, Bloomberg Wall Street Week anchor David Weston there. Thanks for joining us on the passing of Pope Francis. We will have more ahead on the Age of Trade in a moment. This is Bloomberg. Let's take a look at Tesla, particularly beaten up today, off by almost 6%. We will get earnings from Tesla this week. Dan Ives of Wedbush has been quite strident in his view here. He sees Tesla suffering 15 to 20% permanent demand destruction due to some of the work of Elon Musk around Doge and his government work. Dan Ives saying anyone who thinks the brand damage Musk has inflicted is not a real thing, spend some time speaking to car buyers in the US, Europe and Asia, and you will think differently after those discussions. Tesla off 43% year to date. Well, let's get the latest now from the corporate front. NVIDIA CEO Jensen Huang has met with Japanese Prime Minister Shigeru Ishiba, pushing for more electricity generation to power AI. Huang says they discussed Japan's strong position to develop AI, given its leadership in robotics and industrial manufacturing. Earlier, Huang visited Beijing as President Trump ramped up restrictions on NVIDIA's AI chip sales to China. TSMC says it faces challenges ensuring export control compliance by its customers. The company made the statement in its annual report months after its AI chips were found to have ended up with sanctioned Chinese firm Huawei. TSMC says its role in the chip supply chain limits its ability to prevent unintended uses of its semiconductors through intermediaries or third parties. Macquarie Asset Management has agreed to sell its North American and European public investments business to Nomura for $1.8 billion. The business comprises equities, fixed income and multi-asset strategies with approximately $183 billion of assets under management. The all-cash transaction is subject to regulatory approvals and it's expected to close by the end of the year. So we'll be keeping an eye on Nomura and Macquarie stocks when the Open gets underway here in Sydney, starting in about 32 minutes' time. We have more ahead on the Asia Trade. This is Bloomberg. Here's some of the top political stories that we're following. President Trump says US Defense Secretary Pete Hegseth is doing a great job, despite what appear to be attacks from disgruntled employees. Hegseth is facing staff churn, a leak investigation, and a report that he shared sensitive military attack plans in a second unsecured chat group. A former Pentagon spokesman says the Defense Department has been overwhelmed by staff drama and turnover under the Trump administration.
This is what the media does. They take anonymous sources from disgruntled former employees, and then they try to slash and burn people and ruin their reputations. Not going to work with me, because we're changing the Defense Department, putting the Pentagon back in the hands of warfighters, and anonymous smears from disgruntled former employees on old news doesn't matter.
US Vice President J.D. Vance has discussed trade with Indian Prime Minister Narendra Modi in New Delhi. The White House says their meeting yielded significant progress and finalised a roadmap for a possible deal to reduce the tariff burden. The US has threatened to slap a 26% levy on Indian imports if no deal is reached during a pause due to the end in July. The US has set new duties on solar imports from 4 Southeast Asian countries after a year-long investigation. It found solar manufacturers in the region were unfairly benefiting from government subsidies and selling their products to the US at rates below the cost of production. The new duties affect Vietnam, Cambodia, Thailand, and Malaysia. Harvard University is suing the Trump administration for freezing billions of dollars of federal funding. Harvard President Al-Rikabi says the freeze happened after it refused to follow illegal demands to make changes to governance, discipline and hiring policies, as well as diversity programs. Trump has accused Harvard of failing to combat anti-Semitism on campus. Right, let's take a look at how Japan assets are tracking at the moment. We do have a very strong yen, strengthening again from what we saw yesterday, 140.69 at the moment. That weighed on the Nikkei yesterday. According to these Nikkei futures, it looks like it's going to weigh again today. Futures off by about 0.5%. We've also heard from Japan's finance minister, Katsunobu Kato. He's heading to the US for global meetings today. He says there hasn't been any concrete impact from tariffs yet. But there are concerns. He says he is working with other nations on tariff messaging. So Katsunobu Kato making those remarks in Tokyo before departing with the US. He says he's also going to be holding discussions with the US on foreign exchange. Well, Bloomberg has learned that Japan is setting up a new group of officials from various ministries to respond to the Trump tariffs. Prime Minister Ishiba has told Parliament his country will not just keep conceding to US demands to reach a deal. Bloomberg editor John Herskovitz joins us now from Tokyo. So, John, what does Japan want from the talks and what does the US want?
Japan is looking at a deal that will help roll back the tariffs, which are hitting key sectors like its automakers, steel, and also the across-the-board tariffs, which have been on pause but still are at 10%. Japan has floated a couple of ideas. One is reducing some of the safety and inspections on cars for U.S. cars, and another is on agricultural products. They're hoping that these two things can help iron out some sort of agreement. And for the agricultural products, especially rice, Japan is facing a bit of a rice shortage now, so the political blowback won't be that big. Rice farmers are a traditional base of support for the ruling Liberal Democratic Party. For autos, Japan doesn't see that the U.S. will really grab a huge percentage of the market if it does make these concessions on these non-tariff barriers. What the U.S. wants is still up for debate. It could just be a straight-up deal. There are indications that the U.S. could be looking at some currency aspects of it. Trump has also talked about greatly increasing the amount of money that Japan pays for security, for hosting U.S. troops. These sorts of things could be part of the agreement, part of what the U.S. wants, and these are things that Japan just doesn't want to see as being part of trade negotiations.
So domestically, what might Japan be doing at home to mitigate the impact of the tariffs?
Sure. Japan, the ruling Liberal Democratic Party, is looking at some aspects to support domestic demand, some loans for affected companies. Bloomberg reported on a document that the LDP is circulating that is trying to head off some of these things, hoping to build some support and support the companies and people that are going to be most affected by the tariffs. So we're seeing that coming on the domestic front. How much of an impact it'll have will be difficult to say because the domestic demand and the exports, it's these are two significant things that are affecting the economy.
Is there anything to see here for the Bank of Japan, or is it steady as she goes in terms of policy?
Yeah, we had a report, Bloomberg had a report speaking to people familiar with Bank of Japan policy, where they're planning to stay the course now in terms of interest rates, a gradual increase, but the timing of it is probably going to be delayed. We have a May meeting coming up. The likelihood of any sort of increase is quite low. But the Bank of Japan is saying that they're staying the course, but they're also concerned about the tariffs and the impact on the economy.
All right, Bloomberg editor John Herskovitz there. Let's take a look at how commodities are tracking in this environment. Well, the gold price, that's just cracked another record. It was only 5 days ago that we blew through $3,300 an ounce. Here we are now, 3,443, not really showing any signs of slowing down against this backdrop of uncertainty, trade uncertainty, President Trump putting pressure on the Fed as well. Markets do not like what they're seeing. We've also got crude prices staging a very modest recovery, but the trend line has been firmly downwards. That slide on global demand fears. We do have crude prices hovering around 4-year lows. Volumes are also lower because, of course, we've had a number of countries observing Easter holidays. The iron ore price, not a great deal of change there, hovering just below that $100 per tonne level. Well, South Korea is set to begin trade negotiations with the US this week as well, as it seeks to persuade the Trump administration to ease tariffs. Our Seoul Bureau editor Denny Thomas joins us now. So, Denny, what might the contours of a deal look like between the US and South Korea?
Hi, morning. So it's going to be a bit of a tough rope walk for South Korea. I think it's very clear that the Trump administration wants to have better access to the markets here. So that's one thing that South Korea may be looking to negotiate. I think the bigger uncertainty on the part of South Korea is the fact that we have kind of a interim government in place. So there is also a bit of a question mark: how much can a government which will have a new presidential election on June 3rd? So how much can this kind of the lame duck government can push through something that may then not be valid when a new president comes in? So that's an added kind of an uncertainty that is weighing on South Korea. But all things together, the officials are right now are in a mood to negotiate and see what Trump officials have to offer. They are kind of not going in with something premeditated. They want to see what's on the table, what's discussed. Trump officials have kind of hinted about having this trade dialogue intermixed with the security.
All right, Bloomberg's Denny Thomas there in Seoul, having a couple of issues there with the microphone. We'll get that sorted out. In the meantime, more ahead on the Asia Trade. Stay with us. This is Bloomberg. Let's take a look at how the yen is tracking, continuing to strengthen at the moment. 140.79. It was only yesterday we had a 141 handle there. We did hear from the Japanese finance minister, Kato. He's on his way to the US for meetings today. He says, well, foreign exchange going to be one of the things that he raises there. In fact, Asian currencies in general seem likely to continue to benefit from this slump that we're seeing in the US dollar. And I'm joined now by my colleague, Shery in Tokyo. And Shery, that strengthening yen increasingly becoming something of concern for Japanese exporters.
Yeah, it could become really a concern for Japanese exporters, especially if the appreciation happens really fast. Of course, we continue to watch it, as you said, Paul, because of the trade negotiations ongoing, which could include the Japanese yen. We know that President Trump hasn't really been happy with a weaker Japanese yen. Let's discuss all of this in the broader business environment. Joining us now is Takeshi Niinami, Chairman and CEO of Suntory Holdings. He's also a senior economic advisor to Japan's Prime Minister and chairperson of the Japan Association of Corporate Executives. Always great to see you, Tak. You wear so many different hats that it's such a good time to speak to you.
Thank you. Thank you for having me.
Tell me, how concerning is the business environment right now?
Very much concerning. The reason is if the current tariff negotiation continues as it is, we will be perhaps impacted negatively, perhaps from 1% to 1.2% against GDP negative.
That's for Japan.
Right. So that's really concerning, especially like Hiroshima, where Mazda is operating, they would lose lots of jobs.
Yeah.
So we have to be really anxious, and we are.
And we're not even talking about the U.S. economy, which could also obviously face inflation. Are you seeing any changes in your business?
Yes, I think definitely consumer confidence has been waning tremendously. And consumers are not spending willingly nowadays, so they go to the economy instead of the premium products. So that's really concerning too.
You're already seeing the shift in consumption trends towards affordable products.
Right, that's right.
The thing right now is that President Trump really wants these tariffs in order to bring investments back to the United States, in order to bring supposedly jobs back to the U.S. How difficult is it for businesses to make those commitments in the U.S. market when it's so uncertain?
Well, under the current situation where U.S. economy might go into the recession, it's harder and harder, right? If the economy is good just like before, around the time the U.S. productivity is pretty high, above 2%. That's why U.S. attracted investments from the world. If that situation continued, we would have a strong appetite to keep investing in the United States. So current tariff situation is losing the appetite from other countries to the United States. So this is really, killing the appetite from the world to the United States. So we are losing the appetite to invest in the United States. As a matter of fact, if the economy goes into the recession, right?
Basically, what's happening is that, at least for now, these tariffs could be backfiring on the health of the U.S. economy.
Exactly.
The logic from the Trump administration is that he wants to change what they call unfair trading practices. Are you concerned long term that this might be an end to rule-based globalization, free trade?
Not really, because Japan and the other countries are promoting CPTPP, for example, and RCEP. And China is another locomotive to promote the free trade. So whether it's a good thing or not, I think we will be promoting the free trade in, for example, APEC, including perhaps eventually India. So without the U.S., some countries, including Japan and China, we want to promote free trade.
Can the rest of the world carry the global economy without the world's biggest economy?
I think so. This time, a lot of countries got understood that the U.S. is not the country to support the free trade. And the U.S. denounces the free trade. Bringing the bad situation to the United States. But the free trade creates the, good job creations and, world trade, in history. Lots of innovation happens. So I think Japan should be a flag bearer of free trade, and we will.
Does this make you more skeptical about long-term business in the United States, or is this just a blip because of the Trump administration?
Well, depends on how President will cruise the U.S. economy. And I still believe that the U.S. is the center of innovation. So very attractive for us to invest. But at this moment, if this continues, I don't think very attractive. So we have to find other places, other countries like India, like Indonesia. So we have to have the bigger portfolio of investment. But U.S. is one of them and a key country still. But we have to have the portfolio.
Interesting that you're not mentioning China. Is that because they will take a hit from this trade war?
I think my worry is because of the current tariff policy of the U.S., China will change the direction of their goods to other countries. That will create perhaps disputes with those countries who will receive lots of goods. So because anyway, China has to export. So I'd like to ask China to maintain the current free trade because of their leadership. But they have huge excess products in the country. And they have to export, otherwise they can't keep hiring people. So that's their weakness at this moment to lead the world. But I hope China will understand about their position to keep the free trade. They have to be another flag bearer of free trade in the world.
The trade imbalances that could get worse because
right.
of the ongoing tariff.
India didn't join the RCEP.
When it comes to the negotiations themselves, we know that Japan and the United States are talking right now. What should be on the table for discussion? What can Japan offer in this transactional arrangement?
Well, first of all, we have to definitely think about how we can bring the U.S. automobile. I mean, whether Japanese consumers buy or not, but we have to perhaps deregulate the safety standards to fit the U.S. automobiles if it's really safe. And second thing is we need a rice, for example, now. So we can import to some extent like minimum access, not so that that will not ruin the current rice production system in this country, which is the foundation of the policymakers, anyway. So, and the package of the weaponry purchase from the U.S. Anyway, we have to buy weapons from the U.S. so that we can upgrade our deterrence capabilities. So that is so important. And finally, we should have the joint projects in the U.S. Alaska gas and the shipbuilding. I think we can talk about lots of joint projects in the U.S.
What about Treasury holdings? The government says that they're not going to use that as a negotiating tool.
I don't think so, because Japan doesn't want to retaliate at all to the any kind of action from the U.S. because we like to keep the alliance with the U.S. and Japan is always showing their faith, always being with the United States in terms of security. But in terms of trade, we like to work with China as well. So we have to draw a line between economic security and regular trade. Regular trade, we should promote the relation with with China.
We should promote the relationship between Japan and China for Japan's benefits.
In terms of free trade, except security issues.
Because Washington right now, what we're hearing from the government is that perhaps they will try to incorporate some clauses where trading partners of the United States are also limiting and pushing back on Beijing. You don't think that that should happen?
Well, it's a matter of the economic security. Semiconductors, those which are related to the security itself. But other than the security issues, we should promote the relation because China is our neighbor and the world is intertwined. So China is a key part, and we can't forget the fact.
The Japanese yen could also be on the table. President Trump doesn't like weaker currencies vis-a-vis the U.S. dollar. What will that mean to your business if we see more appreciation from here?
It's another headache, too. We can't change the landscape of Japan's economy right away by reducing the interest rate, for example. That affects, definitely yen-dollar value. But we have to be resilient to be able to respond to that kind of a strong request because our real interest rate is negative, about 1%. We are not manipulating, but they might say, hey, Japan is manipulating, so we have to be ready for that. In that sense, we have to leverage these external pressures so that we can reform Japan. By, I think, definitely we have to reduce the number of companies because we have too many. So I think consolidation and metabolization, I think we have to proceed by leveraging this strong pressure from the U.S.
Do other Japanese CEOs share that vision of potentially using this as a catalyst to bring more corporate reforms and changes to Japan? And is the government doing enough?
50-50. And some know that we make use of the external pressure. And in history of Japan's economy, this worked. So we have to have the, cautiously optimism to change Japan to the better landscape from 30-year sleep.
Tak, we always love having your thoughts and your vision here on Bloomberg TV. Thank you so much for joining us again. Takeshi Niinami, he's the Suntory Holdings chairman and CEO. We have more ahead. This is Bloomberg.
All right, let's take a look at how some of the haven assets are trading at the moment. We're seeing ongoing strength in the yen, also the euro, gold as well, punching through that 3,400 an ounce barrier. It was only 5 days ago that we pushed through 3,300 an ounce. The yen continuing to strengthen, although this is as much as anything else a story of ongoing dollar weakness as President Trump once again threatens the independence of the Fed, repeating his calls for the removal of Jay Powell and for him to immediately cut rates. So it's rather curious, isn't it, that we have a havens board there, which is absent the US dollar and US bonds as well. We've seen a fair bit of curve steepening in treasuries also. Let's take a look at how we're shaping up for the market opens in Japan, South Korea, also here in Australia. Australia returning from a public holiday for Easter Monday. So we've got futures currently pointing higher to the tune of about 0.25%. A little bit of weakness though that was S&P futures that are pointing higher. Aussie futures pointing lower, perhaps unsurprising considering the selling we saw in the US. Nikkei futures also pointing lower, perhaps a function of that yen strength. A couple of stocks to watch at the open. The Japanese bank Nomura, the Aussie bank Macquarie. Nomura agreeing to buy Macquarie's US and European public asset management business for $1.8 billion in cash. So might see those two big names moving at the open. Market opens in Sydney, Seoul and Tokyo next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens after a broad pullback from U.S. assets. Paul, we're talking about stocks falling, the dollar falling, long end treasuries declining after President Trump again criticized Chair Powell. Really, U.S. investor confidence very much hit.
Yeah, very much so, Shery. The market's not really liking this idea that there might be a threat to Fed independence. The US dollar among those assets suffering again for a second day. We're seeing a lot of movement into the yen, a lot of strengthening there for the Japanese currency.
Yeah, we're talking about the strongest level since September, with the U.S. dollar, of course, falling on the other side of that trade to that 15-month low. We saw already how the strength of the Japanese yen has weighed down on Japanese stocks. Take a look at how we're opening right now with the yen at that 140 level, headed towards more strength on the overnight session. We saw the Nikkei now in the topics opening 0.4 to the downside. Of course, we have heard about this emergency proposal that might make it through the government, which includes supporting businesses when it comes to those loans, basically just trying to support the economy given this tariff hit. We're already hearing from Bank of Japan officials, though, continuing to say that will not really change the rate trajectory for monetary easing. But we continue to watch really JGB yields as well, because the long end has already shot up. We're seeing the 10-year yield at that 131 level. Take a look at how Korea is also opening. We do have some big earnings coming up later this week as well, including SK Hynix. Of course, we continue to watch the semiconductor side. We continue to watch automakers. The Kospi downside of 0.4% at the open, and a little bit more weakness on the Korean won. We already heard from the BOK Governor Lee Chang-yong talking about these tariffs on Vietnam, on China, potentially affecting South Korea as well, Paul.
Well, we've just opened up for trades here in Australia. We do, of course, have the staggered open for the ASX, so a little bit difficult to get a read on things at the moment, but we're seeing a little bit of softness creeping in. Perhaps unsurprising, we're off by about 1/10%. Macquarie, by dint of starting with an M, will be one that we watch later on when it starts trading in a few minutes, because, of course, we just have heard that Nomura has agreed to buy Macquarie's US and European public asset management business, $1.8 billion in cash. That's expected to close at the end of 2024. 145. Nomura, meanwhile, off by about 1% in Japan. Now, the yield space is an interesting one to keep an eye on. We see yields for the 2 and 10-year continuing to move a little bit lower. Curve steepening becoming very much a theme. Short-term yields slipping, but we've got a 30-year yield approaching 5%. So we've got the steepest curve since January 2022. And as we've been discussing, the bond market really not liking what it's seeing around President Trump's threats to Fed independence, Shery.
Yeah, could that mean replacing Fed Chair Powell with somebody that's more inclined to rate cuts? Would that mean cutting rates? Would that mean more inflation? Then what would that mean to yields? And of course, perhaps even a flight to safety in treasuries. Really, those are wild cards right now that the market is trying to decipher. Joining us now is David Chao, Global Market Strategist, Asia Pacific at Invesco. David, great to have you with us. As I mentioned, I mean, there are so many different uncertainties at this point, but it seems the consensus in the markets is fleeing U.S. assets for the time being. The dollar, of course, has sank as well. Do you expect this trend to continue for the time being?
Well, I think uncertainty is the word of the moment, and many of the Trump-related trades that did really well heading into the early part of this year have certainly reversed since then. I'm not sure that we're going to see investors completely flee American assets, but there is certainly a development of investors thinking about other places to put their money, whether if it's in the Japanese yen or gold or Asian credit or other risky assets outside the U.S. I think it makes sense to continue to be diversified.
Where are you diversifying to? Are those assets, are we talking about perhaps emerging markets as well? We have seen emerging market local bonds rally this year as well.
I think that will continue. I think that investors will want to look at places, at locales where the economies are relatively less impacted by the tariffs. And to be frank, I think the U.S. economy is going to be hit much harder when we weigh in all the tariffs combined compared to other places like China or Europe. And in those respective regions, we're starting to see more muscle fiscal and monetary policy to reflate the economies. And so we like those regions where stimulus measures are coming.
In terms of looking for dip buying opportunities, is there anything that you're looking at? I mean, one theme that's come up is Asian consumer staples. Is that a sector that you'd like, or is there anything else where you're seeing some bargains at the moment?
I think that Chinese equities, particularly Chinese tech, has some significant room to run. We forget about that wonderful DeepSeek AI development that really caused both the Hang Seng Tech Index to be bolstered earlier this year. That's a multi-year investment theme that we think remains to be very attractive.
In terms of looking for havens, obviously gold's been a very popular trade, but in the space of 5 days, we've seen a blast through 3,300 an ounce, now 3,400 an ounce. We're seeing the strongest momentum for gold since 1979. Is this starting to look a little bit overheated to you, or is there more to run?
Well, there's been some recent talk about the U.S. dollar maybe moving back to the gold standard. If that were to happen, I think the price of gold could, triple. But I don't think that we're moving back to the gold standard. The buying that we've been seeing has been due to, central banks, but also recently investors in places like China and India. We're starting to see a lot more interest in gold ETFs. So I think that for investors that have not held gold as part of our diversifier for their stores of wealth, it could make sense to continue to be adding to their portfolio at these levels.
David, I'm very surprised that you actually like China at this point. That's a very bold call at a time when, of course, China and the United States are in this trade war. And it seems like it's just getting started. So is your expectation that perhaps all of the spending that Beijing will have to do in order to buffer their economy could offset all of the consequences from the tariffs?
I think that the headwinds that China faced externally have certainly been amplified with the tariffs. But if you look at the fundamentals of China's economy, they continue to be very strong. Both Q1 GDP surpassed expectations in that mid 5% range. And so even if the tariffs take a bite out of China's exports, we think that the government has more tools than it needs to help buffer growth. But in general, we like economies, we like places where stimulus is going to happen. That should provide a floor both to the markets and to the economy.
Especially when it comes to Europe, right? It seems that views about European assets continue to change, especially with the change in stance from Germany. And of course, we have the ECB continuing its rate cuts.
That's right. We saw ECB enact more monetary stimulus and expansive policy, which tends to be good for risky assets. The defense spending announced by Germany and possibly by many other European or NATO countries coming up in the next few years should also provide a multi-year boost to fundamentals and to economic growth in the Eurozone. And so that's why we continue to like Europe. We continue to like China. And also, EM has done surprisingly well, given that the Fed has been on hold, and we started to see Asian central banks already start to cut rates. That interest rate differential certainly will provide, will have a few headwinds to Asian currencies this year. But I think that Asian central banks are cutting rates because inflation is not a problem in the APAC region, and also they want to support growth in light of some of these external headwinds.
All right, David Chao, Global Market Strategist, Asia Pacific at Invesco. Thanks so much for joining us today. Let's take a look at a couple of stocks we were expecting to move today, and they are moving. That is Nomura and Macquarie. Nomura off by about 0.9%. This after agreeing to buy Macquarie's US and European public asset management business. The deal worth $1.8 billion in cash, expected to close end of 2025. Nomura is holding a briefing on this deal at the moment. We're hearing from the CEO, who says that this deal is key to global investment management expansion. The acquired operation will continue to be led by Sean Little, and this deal is going to help Nomura achieve its firm-wide 2030 return on equity target. So Nomura buying Macquarie's US and European public asset management business for $1.8 billion in cash. We have more ahead on the Asia trade. This is Bloomberg. The annual spring meetings of the IMF and World Bank are getting underway in Washington, with the Trump trade war topping the agenda. Bloomberg senior editor Ramzi Al-Rikabi joins us for more from the US Capitol. So Ramzi, what's the message that these finance ministers and central bankers are going to be delivering in Washington? And I guess more importantly, is that message going to get received?
Good morning, guys. That's the big question going on right now, because in these sort of meetings with the IMF and the World Bank, as well as the G20 here in Washington, it's usually expected that the U.S. would be a sort of a leading force for multilateralism, for bringing some of these countries together to try to address some of the biggest threats, usually to the global economy. We've seen in the past under Biden, bringing folks together in the shocks of the Russia's invasion of Ukraine, and before that COVID, before that the global financial crisis, 2008. But the interesting thing now is that the call is coming from inside the house. The risk now is Washington itself, Trump's trade war, Trump's tariffs, to these threats that he's unleashed on the whole globe, and then tried to scale back a bit and then focus on China and rally allies around there. So it's an incredibly destabilizing time for countries. The phrase you hear a lot among
the analysts or even the IMF is a high degree of uncertainty about what's going on. So these finance ministers, central bank governors, bondholders, investors, bankers are all gathering here, typically to take the temperature of what the risks are and where to go forward from here. They'll be getting sort of some new forecasts from the IMF, which sort of has the global baseline outlook. The last week, the managing director signaled that there'll be some downgrades, so she doesn't expect a global recession. Our own Bloomberg Economics today downgraded their global forecast to 2.7% this year, bringing the U.S. growth down to 1.3% amid these trade wars. So we're expecting to see a lot of these folks coming in to try to assess how they see the U.S. As a risk to the global economy, but at the same time try to figure out how they think they can diffuse the risk to them.
President Trump warning about the U.S. economy because of his own tariffs, and actually, interestingly, talking about there virtually being no inflation. I'm not sure if you can actually tell that to American consumers at groceries right now. But what is the point that he's trying to make about the Fed not doing its job?
It's a whole new level of risk, and we're seeing in the markets now. He's calling on Powell to cut rates. He's had some pretty choice words for him recently. He's seeing what they've done in the ECB in terms of cutting rates, and he wants Powell to do the same. He's threatening to fire him as well. That's having the consequence of that. As you see, not only stock market selling off, the dollar selling off, the treasury yields are rising. It's creating a whole downside risk for American assets, and there's a worry that could create some sort of financial risk beyond just these trade risks. Again, I think if you put that next to the trade war and this threat to U.S. Monetary independence, there's a high level of risk for the global economy, for the U.S. economy, and how that spreads to the global economy.
Al-Rikabi, Bloomberg senior editor, great to have you with us as we'll continue to wait for more data points, right? This week we get the PMIs not only from the U.S. but across Japan, Europe as well. The first indications of where manufacturing activity, services activity will go, Paul, at a time when we continue to hear about these potential downgrades to global growth, right? We are expecting the IMF forecast this week as well. Bloomberg Economics has already come out with its own forecast saying that these tariffs coming from President Trump will shave about $2 trillion off global output by the end of 2027.
Yeah, the growth outlook is not too pretty either, as one would expect. The global GDP forecast now shaved down to 2.7%. That's the weakest we've seen since 2001. If you strip out the global financial crisis and the pandemic as well. So tariffs, well, it means stagflation for the U.S., disinflation for everybody else, according to Bloomberg Economics. Shery.
And of course, we see the ongoing trade negotiations in order to stave off these tariffs. Japanese Finance Minister Kato heading to Washington today, set to discuss currency issues with U.S. Treasury Secretary Scott Bessent. Kato says Japan is working with other nations on how best to express widely shared concerns regarding Trump's tariffs. Bloomberg editor Brian Fowler joins us now with the latest. And we know that there have been already the first round of trade negotiations. We are expecting to hear from the finance minister himself. What exactly is on the table, and what can Japan really get out of this?
Yeah, so Shery, we also heard this morning from Japan's chief trade negotiator, Akazawa, who said that he shares Ishiba's beliefs that Japan's farmers have to be protected. So it appears that Japan's drawing a line on agriculture ahead of the second round of talks. But I also thought, as you mentioned, Kato leased for Washington today. He said Japan is already in close contact with other countries about how best to voice these concerns about tariffs. And I think that's quite interesting because it looks as though most of the world is kind of coming together and to share this criticism of the tariffs. And of course, that comes against the backdrop of a lot of other things we've seen. We were talking about the IMF releasing its updated World Economic Outlook today. Also last week, the WTO released new estimates saying that trade is now expected to actually decrease this year, whereas Previously, it was expected to expand by 2.7%. So there's been a sea change in terms of what's happening with global commerce. And I think there's this widely shared worry about what that's going to do to the whole world.
And to just individual economies, right? The finance ministry here in Japan just releasing a survey that shows about 10% of companies already hit by the effects of these tariffs. I mean, what can be done at this point to mitigate some of that impact?
That survey came out just this morning, and I would expect that number would rise significantly as we go along with this whole tariff campaign, especially after that 90-day window closes and the reciprocal tariffs go up, if that's what indeed happens. I think what Japan can do, so far they've talked about not actually doing a supplemental budget. That's what Ishiba has said consistently. Remains to be seen if that's actually going to be the case, but they can still come out with financing help for companies that are directly affected. And also, of course, there's the BOJ. And so for the latest we've heard from the BOJ is that it's not going to change its policy stance right now in terms of wanting to raise interest rates if it has another chance. Next decision is on May 1st. I think there's no question that the BOJ will stand pat. But then we need to hear what they will say about the outlook for possible rate hikes later this year.
Right. What about the fact that potentially a weak Japanese yen could be on the table, right?
Well, that's been a sore point in the past for the U.S., but if you look at dollar-yen trends over the last month or so, it's actually going in the right direction. So I would expect Besant, if he's supposed to meet with Kato when Kato gets to Washington at some point, timing for that meeting hasn't yet been set. I think it would be a little bit odd for the U.S. to really raise that as a concern at this point, given the way the dollar is already under pressure, not just against the yen, but against other currencies. And given the instability in markets, I would think that the message has to be something more like stability and everything is fine, but we'll have to see on that.
A little bit of a breathing room given the macroeconomic gyrations
I think so.
right
Everybody
now.
needs a little breathing room at this point.
That's so true. Brian Fowler joining us here with what to expect from those trade negotiations between Washington and Tokyo. As we're watching also futures trading in Europe just opening right now, we are seeing broad downside, and this of course coming at a time when the dollar is under pressure, when risk assets are under pressure. Overnight we saw that veering away from U.S. risk assets, including, of course, the pullback from long-dated treasuries also declining, which has been interesting, really perhaps a reflection of really the confidence when it comes to U.S. assets at this point. And keep an eye on the euro, which already surged to the highest level since 2022 against the dollar, and right now is holding at that 1.15 level, Paul.
You're seeing a little bit of strengthening in the Aussie dollar as well off the back of greenback weakness, 64.16 at the moment. The ASX, meanwhile, slipping a little bit, coming back from Monday's public holiday. We're off 2/3%. We are seeing Macquarie, though, stronger by 0.5%. This is after reaching that agreement, as we were discussing, with Nomura, agreeing to buy Macquarie's US and European public asset management business for $1.8 billion in cash. We've also had Morgan Stanley upgrading Australian stocks, trimming though its ASX target to 8,000 from 8,000 to 500, but saying that minimal first order tariffs and supportive fiscal settings are going to make the ASX attractive for now, Shery.
And take a look at how U.S. futures are also trading at the moment after that big sell-off that we saw in U.S. assets. We talked about U.S. stocks falling, the dollar falling. We're seeing a little bit of a rebound in the early Asia trading session. But remember, the S&P 500 has already tumbled almost 10% or so since the global tariffs on April 2nd were unleashed by President Trump. That's already wiped out almost $5 trillion in market value. So this little upside really in focus as we continue to watch U.S. financial assets. This is Bloomberg. Tributes are pouring in for Pope Francis after his death at the age of 88. Italy's Prime Minister Giorgia Meloni called him a great shepherd, while President Trump says he and the First Lady will attend the Pope's funeral. Here's a look back at the life and legacy of Pope Francis.
Pope Francis will be remembered as a spiritual leader who encouraged Catholics to embrace more compassionate views on many issues of church doctrine. But his legacy as pontiff will also be marked by his failure to deal decisively with past abuse by clergy. Born Jorge Mario Bergoglio in Buenos Aires, he entered the seminary in his 20s and joined the Jesuit order known for its work on behalf of the poor and for social justice. Bergoglio later became a bishop of Argentina's largest archdiocese and eventually a cardinal before being elected the 266th Pope in March of 2013. Francis was a first in many respects, the first Pope of the Americas, first non-European since the 8th century, and first Jesuit. His humility and calls for compassion stood in stark contrast to his predecessor. He captivated many liberal non-Catholics with his focus on poverty and human suffering at a time when far-right political groups were on the rise globally.
The fight against poverty and hunger must be fought constantly.
But Francis's expansive message faced pushback from a polarized clergy and hidebound Vatican bureaucracy. He abolished the highest level of secrecy used to protect pedophiles within the church, yet largely failed to satisfy victims' demands for accountability. He advocated for a freer discussion of homosexuality, divorce, and the role of women in the church, but progressives didn't find him revolutionary enough, while conservative Catholics felt he went too far. Francis weighed in repeatedly against the inequities of the global economy. He used his pulpit to call attention to the climate crisis and the plight of migrants.
We must not be taken aback by the numbers, but rather view them as persons, seeing their faces and listening to their stories, trying to respond as best we can to their situation.
And he left a final institutional legacy reconfiguring the College of Cardinals that will select the next pope, making it more likely that person will be from Asia or Africa.
Let's take a look at how some of the haven trades that we're following are tracking at the moment. Seeing, well, a little bit of softness for the yen, relatively speaking. We're back above that 141 level after hovering around 140 for most of this morning. The gold price, interesting as well. It was just 5 days ago that we blew through 3,300 an ounce. Now here we are at a fresh record, 3,429 at the moment. The yield on the 2-year just nudging down a little as well. For more on this, let's bring in Garfield Reynolds, who leads our Markets Live Asia coverage. Garfield, I just got to point out that it does feel a little bit odd having a board of haven assets. There's no greenback. There's no treasuries there either, apart from to say, well, the yield curve's steepening.
Yeah, well, that's the world that we're in these days. As markets catch up to the massive transformation that's going on, both the actual impacts of tariffs, the apparent threats to Federal Reserve independence, and the underlying push from the Trump administration, which is to remake a global financial system that had the US, still has the US effectively, at the center of that system, and in many ways was sort of designed to have that there. Now, Trump is remaking that, certainly attempting to remake that, and he's also signaled he'd be quite, he thinks the US dollar has been too strong. That's part of what has led to the withering away of US manufacturing. So you add all that in, and the US dollar becomes a much less certain place to put your money. And that's part of what's happening. The potentially scary thing, perhaps, is that there are plenty of signs that there hasn't actually been that much money, as it were, coming out of US assets. It's just a lack of a willingness to bid them up, and perhaps restraint in adding to US assets at the sort of pace that had been the case. If we do get a serious turn to move money out of US assets, that could get very, very ugly indeed.
Tell us about how ugly that could get, because we've been talking about the significance of the dollar taking up, more than about 90% of foreign exchange trades around the world. Foreigners holding so much of U.S. equities as well. What are the global implications of the U.S. really losing its credibility as a go-to haven sort of destination for all of this capital?
Well, I mean, one way to look at that, Shery, would be, if you look at the way gold has been taking off, over the last year or so, that's partly been driven by central bank buying, and then the way that that's all sort of interacted. So I was looking at this morning, depending on exactly what measures you look at, gold is now something like more than 20% of the world's FX reserve, total FX and other reserves held by central banks, from about 12% for much of the previous decade. That still has it sort of neck and neck with the euro. US dollars, meantime, are sort of 57 to 60%. You would think that in a world where the US dollar is no longer regarded as stable enough to be sort of the sole reserve currency, if you had a serious move to a new order, then you would think the euro and gold between them would climb further to be, so you had sort of parity, as it were, like, say, I don't know, 25% gold, 25% euros, 25% dollar. That would be an enormous drop. You talk about the dollar dropping as a reserve holding by about 50% of what it is now. That's something like $3.5 trillion worth of dollars going into something else. So that would make some of the moves that we've seen so far seem like small change. Similarly, in stocks, the foreigners add an enormous amount to their US equities holdings over the last decade or so. So that's part of what helped to drive the S&P 500 up ever higher. It's now struggling to hold on to where it is. You would think it could go back, who knows? I've seen people positing that a US recession could send the S&P 500 to 4,000. That sounds like a reasonable level to start with, if you had, it's very big if you had this move. And part of what might argue against this move is precisely that, investors are to some extent trapped by the fear that if they really start selling and if it really gets going, well, where do they go? Doesn't everything come crashing down? They're sort of in a bit of a prisoner's dilemma, as it were, because they put so much into US assets that were seen as not just being havens, but being, the best place to be. For the last decade, you got rewarded if you bet everything on the US.
Yeah, really no alternatives at this point when it comes to safety, right? Bloomberg's Garfield Reynolds here with the latest on the markets and, of course, that broader moves that we're seeing away from U.S. assets. And these are some of the other political stories that we're following at the moment. Harvard University suing the Trump administration for freezing billions of dollars of federal funding. Harvard President Alan Garber says the freeze happened after it refused to follow, quote, illegal demands to make changes to governance, discipline, and hiring policies, as well as diversity programs. Trump has accused Harvard of failing to combat anti-Semitism on campus. President Trump says U.S. Defense Secretary Pete Hegseth is doing a great job despite what appears to be attacks from disgruntled employees. Hegseth is facing staff churn, a leak investigation, and a report that he shared sensitive military attack plans in a second unsecure chat group. A former Pentagon spokesperson says the Defense Department has been overwhelmed by staff drama and turnover under the Trump administration.
This is what the media does. They take anonymous sources from disgruntled former employees, and then they try to slash and burn people and ruin their reputations. Not going to work with me, because we're changing the Defense Department, putting the Pentagon back in the hands of warfighters, and anonymous smears from disgruntled former employees on old news doesn't matter.
The U.S. has set new duties on solar imports from 4 Southeast Asian nations after a year-long investigation. It found solar manufacturers in the region were unfairly benefiting from government subsidies and selling their products to the U.S. at rates below the cost of production. The new duties affect Vietnam, Cambodia, Thailand, and Malaysia. The White House says talks between Vice President J.D. Vance and Indian Prime Minister Narendra Modi yielded significant progress in trade negotiations. New Delhi is seeking to strike an early deal to avoid Trump's additional tariff hikes. White House correspondent Akela Gardner is with the Vice President on his 4-day trip to India, and she joins us now from Jaipur. Akela, good to have you with us. And just before coming on the air, you were telling us how chaotic this trip has been. How busy has the schedule been, and what's been achieved?
Well, the first leg of this trip was Vice President Vance in Italy, where he had somewhat of a Catholic pilgrimage. He is someone who converted to Catholicism in his 30s. He was baptized in 2019. He met privately with Pope Francis and became the first, or the last world leader, I should say, to meet with the Pope before his death on Monday. And so that was a hugely significant moment for the vice president. Also here in India, his wife visited a Hindu temple. So this has really been a trip both characterizing the president on a political stage, but also a personal stage. And that is not something that we have seen him yet to do. And that is something huge to watch, particularly because in the U.S. and among Republicans, he continues to be favored as a potential successor to President Donald Trump. So this is certainly a trip that is sort of painting him as a world leader and putting him on the world stage.
Yeah, so we're seeing a little bit of soft power being exercised here as well, but there's a business end to this trip also in terms of, well, negotiating something on the trade side. There was an intention to have the first tranche of a US-India trade deal stitched up by the end of the year. What sort of progress might we anticipate on that front?
Well, the headline out of that meeting with Prime Minister Modi and Vice President Vance was, of course, this agreement to terms of reference, as they put it in the statement, for an ultimate bilateral agreement. And the way that Vice President Vance's office really characterized this is the last domino to fall, really, for a broader agreement. So this is huge, particularly because it seems that India might be the first, if not one of the earliest countries to really secure that first step. And the Trump administration has really been talking about India amongst this group of countries that it's been prioritizing. It's prioritizing major trading partners in their words, which also includes South Korea, Japan. And this is a huge win for Modi because he has really laid the groundwork in order to achieve a deal far before President Trump threatened to put a 26% hike. We saw them meet at the White House in February, and we saw Modi remove some tariffs on things like Harley-Davidson motorcycles, Kentucky bourbon, really popular American products that he has put these high levies on. And he was anticipating that this could potentially be the result of President Trump's threats about tariffs and trade, and that, of course, ultimately was. And so they're hoping to avoid these completely, but we still don't know yet what will be the ultimate percentage that these two countries agree with.
Akela, how much has China loomed in the background of these conversations, given that, of course, it's no secret that Washington wants New Delhi as a partner in pushing back against China?
Well, this has really been an effort that has really preceded President Donald Trump. It is something that President Joe Biden also wanted to do, was to create a closer partnership with India as a bulwark to China. That relationship was really more complicated with President Biden because of India's ties with Russia, continuing to buy Russian oil exports. And yet it seems a lot different under President Donald Trump, who, of course, is trying to end the war in Ukraine and has a much better relationship when it comes to President Putin. And so it seems that these two countries are sort of on that parallel track once again in hopes of really creating a closer partnership when it comes to trade and economic priorities.
All right, White House correspondent Kayla Gardner there in Jaipur. More ahead on the Asia trade. This is Bloomberg. As Australia heads towards the May 3 election, both the government and opposition are supporting the use of critical minerals as a potential bargaining chip to negotiate exemptions from US tariffs. Joining us now is Ian Satchwell, adjunct professor at the University of Queensland Sustainable Minerals Institute. Ian, thank you so much for joining us today. Critical minerals is one of those industries that's long been touted as having tremendous potential in Australia, but do you feel that potential is being realised? And perhaps the most recent example of that has been the Future Made in Australia plan to put critical minerals front and centre. Has this initiative borne any meaningful fruit so far?
It's bearing some fruit, Paul, but there's much more upside to come if post-election policy settings allow for it, and critically, if markets for critical minerals in the US, Japan, South Korea, and of course China, Australia's biggest minerals customer, allow for it.
Yeah, and to what degree does China cast a long shadow over this industry? Because it does control something like 90% of the world's critical minerals supply. Is it cost effective for Australian producers to compete with China?
Well, Australian producers are some of the largest suppliers of critical minerals, mined product, to China. Often those minerals go to China for processing. China controls much of the world's minerals processing, from copper through to rare earth elements and lithium as well. Of course, that's very important for battery minerals. And so Australia is very dependent upon China. And Australia is one of China's major minerals suppliers, critical minerals plus other minerals like iron ore. So China is and will remain very important. The trick is for like-minded countries to diversify and secure critical minerals supply chains, particularly in the face of Chinese market manipulation and withholding of supply, as we've seen in the last couple of weeks in relation to many or several rare earth elements. So China is important to Australia as a market. The US is a small minerals market at this time, but an important future minerals market. And of course, Japan and South Korea, and in the future, Europe will be important markets as well.
Professor, how well has Australia done in diversifying those energy clients so far? And what else needs to be done by the government in order to ensure that China is not just the biggest client?
It is important to diversify, as I said, for Australia, but it's also important for minerals customers, mostly manufacturing nations, to diversify their supply chains as well. How well that's going? It's not going so well so far. Australia has signed some 27 agreements with customer countries or potential customer countries around critical minerals supply chains, but it's early days still. And Paul mentioned earlier the Future Made in Australia policy of the current government, and we'll see what the election results bring. But the Future Made in Australia policy is very much about manufacturing using Australian critical minerals. But nations, customer nations like the United States, for example, and Japan and South Korea, are very focused on processing domestically as a key part of securing their supply chain. So there's a tension between Australia's desire to process its critical minerals and export more value-added critical minerals, and the desire of customer nations to do processing onshore for security issues, for security reasons, but also to add value domestically. And there's a bit of a subsidy arms race on at the moment, and I'm not sure that Australia can match, for example, the deep US subsidies that are available.
In terms of the refining of critical minerals, there is a desire, as you mentioned, to onshore that, or at very least friendshore it, but it's not exactly an environmentally friendly process, and I'm assuming it's a time-consuming one as well. So can you give us a sense to some of the barriers as to doing that?
Well, the environmental impact of minerals processing can be managed. Rare earth elements often have some radioactivity associated with them, so that takes some particular management, but the impacts can be managed. It's really about the cost of construction of new minerals processing plants, the technologies required, and China dominates processing technologies for a number of minerals, particularly lithium and rare earth elements, and then the operating costs. And Australia is a high wage country and has quite high operating costs relative to some of its customer countries. So it's imperative for Australia to do what it can to, one, reduce the cost of construction, two, reduce the cost of operation, and three, permitting by governments is also an issue, and the time taken. So shortening that permitting time will help Australia to be more competitive.
All right, Ian Satchwell, Adjunct Professor at the University of Queensland Sustainable Minerals Institute. Thanks so much for joining us today. And we have more on Australia ahead every Tuesday, 10:40 a.m. if you're watching in Sydney. That's 8:40 a.m. in Hong Kong. Plus, you can tune into the Bloomberg Australia podcast, which delves into the biggest stories shaping the country's role in global business. You can find it on Apple, Spotify, or Bloomberg.com. More ahead on the Asia trade. This is Bloomberg.
Macquarie Asset Management has agreed to sell its North American and European public investments business to Nomura for $1.8 billion. Bloomberg's Russell Ward joins us right now, and you can see Nomura Holdings there losing a little bit, about 1%. But does it make sense for Nomura at this point?
Hi, Shery. Yeah, I mean, this is quite a surprising piece of news this morning, particularly coming against the backdrop of all this uncertainty with the trade war. But yeah, basically, Nomura has announced that it is buying this asset management business from Macquarie. It's going to cost about $1.8 billion, which is set to be Nomura's biggest ever deal. And the company is going to be gaining $180 billion worth of client assets, stocks, fixed income abroad. And really, I think this is part of the CEO Kentaro Okuda's plans to sort of capitalize on the recent trend of Japanese people being more willing to invest more of their savings. And also, it's in line with his plans to sort of generate more stable fee income and reduce reliance on volatile trading and investment banking businesses. So that's the backdrop, and that's behind the surprising news this morning. Yeah.
But yeah, as you said, I mean, given the backdrop of the trade war, not to mention, how have they fared historically when it comes to these deals overseas?
Yeah, that's a good point. I mean, Nomura has actually been kind of notorious for some missteps abroad, most famously in 2008 when it bought Lehman Brothers assets, Asian and European businesses of Lehman right at the peak of the global financial crisis. That didn't turn out well. The company has really struggled to sustain profits abroad, and only recently in the past few quarters has it managed to do so. And then, just even a few years ago, it also had another misstep with the debacle surrounding Archegos, which you remember was the family office of Bill Huang, which suddenly collapsed and ended up pretty much bringing down Credit Suisse, and it was a major step back for Nomura at the time. So now, right down at this time of huge uncertainty with the trade war, Nomura is now waiting in overseas, so it is a really big bet for them.
All right, Russell Ward there in Tokyo. We're getting some breaking news out of Boeing. We're hearing that Thoma Bravo is said to be getting near a deal for Boeing's Jeppesen unit, Jeppesen being a navigational operations planning software provider. Boeing acquired that way back in 2000. Been looking to unload that for a little while now. Apollo Global Management, Citigroup had been previously reported to be offering financing worth around $3.5 billion for the carve-out of that navigation unit Jeppesen. But we're hearing that Thoma Bravo reported to be near a deal to acquire that unit. We'll bring you more details as we get them. Let's get the latest now from the corporate front. LG Energy Solution has pulled out of an $8.5 billion partnership with Indonesia to build a full EV battery supply chain. The South Korean company cited market conditions and the investment environment. LG's withdrawal is a setback for Indonesia, which is trying to leverage its large nickel reserves to attract foreign investment. South Korean shipbuilder Hanwha is planning to construct the first US-built LNG tanker. The expansion comes after the US trade representative unveiled sweeping recommendations to tax ships made in China. Under the proposal, as many as 5 to 7 US-flagged and US-operated LNG carriers would be required before the end of the decade. All right, that is it for the Asia trade. We do have markets coverage continuing as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen. The China show up next. This is Bloomberg.